probably heard a ton about national debt, right? But have you ever stopped to think about what that actually means? When a country like the United States spends way more than it brings in, it has to borrow. So who's on the other side of that loan? Who's providing all that cash? In this explainer, we're going to follow the money and see exactly who owns America's debt.
First, let's just get a sense of the scale we're talking about. The U.S. government is projected to have a budget deficit of $1.9 trillion in 2026 alone. Now, that's not the total debt. That's the gap between spending and revenue for just 1 year. And that gap has to be filled by borrowing.
And all that annual borrowing really adds up. Looking down the road, federal debt is on track to hit 120% of the entire U.S. economy, the GDP, by 2036. So what does that even mean? Well, it means the country's total debt would be significantly bigger than the value of every single thing it produces in an entire year.
Which, of course, brings us right back to our main question. To cover these massive deficits, the U.S. has to sell its debt to investors all over the world. So who exactly are these lenders? Who is buying up all these government IOUs? Well, the answer, it turns out, is changing in some really fascinating ways.
You know, for years, if you asked who buys U.S. debt, the answer was pretty stable and predictable. But lately, we've seen a major shift. It's like a real changing of the guard among the world's biggest buyers. The old players are stepping back, and some new ones are stepping up to take their place.
Okay, so before we meet the players, let's just be clear on what we're talking about. When we say debt, what we really mean are U.S. Treasury securities. Just think of them as a simple IOU from the government. You lend it money now, and it promises to pay you back later with interest. And because it's backed by the full faith and credit of the U.S. government, it's considered one of the safest investments on the entire planet.
So, who's the big player that's stepping back? Well, for years, a colossal buyer was the U.S. Federal Reserve itself. I mean, just look at this chart. Back in 2021, it held over a quarter of all Treasury debt. But through a process called quantitative tightening, which is really just a fancy way of saying it's letting its old bonds expire without buying new ones, its share has shrunk dramatically, down to just 14% today. That leaves a huge gap that needs to be filled.
And that leads us to the next most logical question. If the single biggest buyer is trimming its holdings, who on earth is stepping up to buy trillions of dollars of new debt? Well, let's meet the new lenders.
All right, first, let's look right here at home, inside the U.S. The gap left by the Fed is being filled by a surprisingly diverse group of domestic investors, and each of them has their own reasons for buying in.
A huge piece of this puzzle is money market funds. Here's what happened. When the Fed raised interest rates, the interest on your regular savings account didn't really keep up. So people and companies moved trillions of dollars into higher-yielding money market funds. And what do these funds do with that mountain of cash? You guessed it. They buy massive amounts of safe, short-term government debt.
U.S. banks are another key player. Just look at the steady upward climb on this chart. As customer deposits have grown, the money we all put in our bank accounts, the banks need a safe place to park that money and manage their risk. Well, U.S. Treasuries are the perfect tool for that job, so their demand has risen right alongside their deposits.
Then you have this massive category simply labeled households. Now, while that does include regular individual investors, a big driver here is actually sophisticated players like hedge funds. They use treasuries for all sorts of complex trading strategies, and as this chart shows, they've become a large and very steady source of demand.
Okay, so that's the domestic picture. But U.S. debt is a global asset, we all know that. So let's shift our focus overseas, where we find another huge structural change unfolding. It's really a tale of two very different types of foreign investors.
This slide just illustrates that split perfectly. On the left, you can see that orange section surging. That's private foreign investors, like international banks and pension funds. They're buying more U.S. debt than ever. But now look at the blue section on the right. That represents foreign governments and their central banks. Their holdings are basically flat, as they slowly diversify their massive reserves into other assets, like gold.
So why does this shift matter so much? Well, it's because these two groups have completely different motivations. Official investors, the governments, they often buy for geopolitical stability. They're steady, long-term holders. But private investors, they're driven by profit. They're way more sensitive to interest rates and will sell if a better opportunity comes along. This shift means more of America's debt is now held by these more price-sensitive buyers.
So what does this new landscape of buyers mean for the future? Let's look at the factors that could support demand for U.S. debt. Let's call them the tailwinds, and then the potential threats on the horizon, the headwinds.
It's really a mix of forces. On the plus side, an aging U.S. population is naturally going to seek out safer investments. and new technologies like stablecoins, digital currencies pegged to the dollar that are often backed by T-bills, could create brand new demand. But on the other side of the coin, foreign central banks are continuing to diversify away from the dollar. And here's a big one. If treasuries start moving in lockstep with stocks, they lose their main appeal as a safe haven.
Let's look a little closer at one of those tailwinds. This chart shows wealth concentration by age, and it is crystal clear that older groups hold a growing share of it. As people approach and enter retirement, they typically shift their investments from riskier stocks to safer assets like bonds. This creates a really powerful long-term demographic tailwind for Treasury demand.
So, what's the bottom line here? Well, despite all these shifts, a recent Treasury report put it plainly. Demand for U.S. debt remains robust and comes from an increasingly diversified investor base. So, for now, it seems this changing of the guard has been a success.
But this brings us to our final thought. For decades, the entire U.S. Treasury market has been the bedrock of the global financial system. It's the ultimate safe asset. But the investor base is changing, the motivations for buying are evolving, and the geopolitical plates are shifting. So the crucial question remains, what happens if that bedrock, that fundamental trust, begins to shift?